Awesome. So it is 12 o'clock. I think we should get started. We want to be mindful of everyone's time. So thank you so much for those of you that have joined us today. My name is Jennifer Vivian. I'm the manager of entrepreneurial services at the City of Brampton. And I'm delighted to be your host for this morning's final webinar in our Entrepreneurs Connect series with MNP on business valuations for investor conversations. This session is hosted by the City of Brampton's Entrepreneur Center in partnership with MNP. For those of you that are unfamiliar with that, we're an innovative partnership between the province of Ontario and the City of Brampton, belonging to a very large network of 54 small business enterprise centers across Ontario that offers entrepreneurs various tools and resources to help them start and grow their business. We are a one-stop source of information, education, and access to various programs and services, as well as co-working to help local entrepreneurs and small businesses in the Brampton area. You can learn more about our center by visiting www.brampton.ca/BEC, or you're more than welcome to visit us in person. We're open Tuesdays through Thursdays from 9 till 4. We are conveniently located downtown Brampton at 41 George Street South. We would like to pay special attention to our series partner today, MNP. Without their generous and ongoing support of our center, event series like this would certainly not be possible. If you've ever had a chance to drop by our center, you would have noticed that one of our amazing phone booths has been generously sponsored by MNP, and we are so grateful for their support. The phone booth is a great place for entrepreneurs when they're using our space to touch down in, to make phone calls, or to have private and confidential meetings. So thank you, MNP. MNP is a leading national accounting, tax, and business consulting firm that is truly made in Canada, with offices and communities all across the country. MNP supports small businesses as they grow and innovate, and helps entrepreneurs and business owners to adapt and succeed in a dynamic business environment. The Business Insight section on MNP's website provides timely advice and practical solutions to help you navigate your business journey. Visit www.mnp.ca to learn more, and be sure to subscribe to the MNP Business Insights newsletter. So before we begin with today's webinar, I'd like to go over just a few quick housekeeping items. First off, this webinar is being recorded, and a link to the recording will be sent to you along with a copy of today's presentation. Feel free to share it with any entrepreneurs within your network that might have missed today's session. There will be lots of time at the end for Q&A. Everyone will remain muted, so we ask that you please use the question box on your participant control panel to type in your questions throughout the presentation. Sure to take that up at the end. In the event we are unable to get to your question this morning, or if there's something you think about after today's session is over, we will certainly make note of your question and respond to you directly, or you're welcome to email us. It gives me a great pleasure to introduce our speaker this morning, who's going to help you understand what drives value in your business and how to measure business value for productive discussions with potential and current investors. Amanda Salvatori is a partner in MNP's Valuation and Litigation Support Practice. She effectively addresses the valuation needs of a business through its life cycle, delivering valuation advice and preparing reports for a range of transactions. Amanda's understanding of valuation theory, combined with her knowledge of current market conditions, enables her to provide thoughtful and meaningful insights to her clients. Please give Amanda a very warm Brampton welcome, and I'll let you take it away.
Thank you. And thank you everyone for having me today. So we can skip. So, just in addition to the housekeeping that's already been mentioned, obviously this presentation is for educational purposes only, and that, your specific set of circumstances, might not mirror what we talk about today. So it's always important to get the appropriate advice from a professional. But hopefully as we go through the presentation, it'll be informative, and please feel free to ask questions. I'll probably take the questions at the end. So in terms of the agenda for today's presentation, we'll start by what is the role of a CBV, like often a chartered business valuator. So often, people ask me when a valuation is relevant and what really is a CBV. So we can start with that. Then we'll move on to what is business valuation, what is a business valuation, then value drivers. So what drives value in your business, approaches to business value, like how people typically look at the valuation of a business. And finally, we'll do questions. So we'll start with what is the role of a CBV. So what does a CBV do? So a CBV is an accredited finance professional with a specialization in business valuation. We're trained and governed by the CBV Institute, and oftentimes people have an accounting background, but it's not a requirement. So there are people who come from other disciplines as well who join the CBV Institute. And I think similar to many professions, there's an element of judgment, analytical training, and obviously a lot of technical acumen that goes into becoming a CBV. In terms of like typical engagements that would involve a CBV, often there's income tax planning and compliance, where the Income Tax Act requires a valuation to execute some type of tax plan. Often we see people getting valuations for strategic planning. Sometimes they're in a crossroads in terms of what to do next with the business. Sometimes it's succession planning, and it could be succession planning in the future. Let's say business owners want to put steps in place today to increase value over time. And so as a first step in that process, it's important to understand what the business is worth today and how that fits into your overall kind of financial goals. Shareholder disputes is certainly one area of practice, but just shareholder transactions in general. Typically when one shareholder sells to another shareholder, you don't want to put the business up for sale. So you need some type of value determinant in order to affect that transaction. Certainly as part of any M&A transaction, there's some pricing that goes into that process, and sometimes valuators help therein. And financial reporting, just for financial accounting purposes, IFRS and even ASPE, Canadian GAAP, we used to call it, requires some type of valuations in the context of purchase price allocations or goodwill impairments, or the fair value of investments. And so we get involved in those areas as well. So really anytime value comes up, there's definitely certain valuators that specialize in certain areas of practice, but there is a CBV who can help in most circumstances. So what is a business valuation? So when we refer to a business valuation, like we're determining the value of sometimes assets, sometimes shares of a business, or it could be a partial interest in a business. So it could be a specific segment or subsidiary of a business that we're opining on. And as I previously mentioned, it's really a blend of accounting, finance, and sometimes tax that really goes into the valuation of a business. So how is value defined? And why do we need a definition? So similar to, let's say, when you put your house for sale, your real estate agent might give you an idea of what your business is worth. But it's not until you put the house up for sale that a price is determined. So when we're doing business valuations, we're doing a valuation in what we refer to as a notional setting. So it's kind of in the absence of putting your business up for sale. So we need some type of value term in order to govern the valuations that we do. And I think it's important to understand if you're speaking with a valuator, if you're looking at another valuation, or if you're thinking about valuation in general, kind of the value term that's being used. So more often than not, it's fair market value that's being used. But sometimes, for example, if you look at a financial statement, it's often what we refer to as net book value, which is kind of more of a historical cost. So I think it's important to define value in order to understand kind of, the parameters of what you're looking at. So fair market value is defined as the highest price attainable in an open and unrestricted market between informed and prudent parties acting at arm's length under no compulsion to act, expressed in terms of money or money's worth. So, when we say highest price obtainable, I think it's fairly self-evident, but like an open market, meaning, all purchasers kind of are available to be at the table, informed and prudent parties. So everyone has access to kind of the similar information, and everyone's done their appropriate due diligence and care. So acting at arm's length, under no compulsion to transact. So no one's forced to buy or sell. So you can see that the fair value definition is kind of an optimal value definition and may or may not equal the price that you may be able to achieve in an open market. So if you actually put your business up for sale. I think there's several valuation principles that guide valuators, but I think the two most important ones are that valuation in a notional setting is prospective or future oriented, and it's determined at a specific point in time. So why is that important? So, when we think about business value, like where is the value being derived? So an investor is looking at the value that the business can generate kind of on a go-forward basis, obviously post their acquisition of the business. So I would say that historical results are often a guide with which people assess the cash flow that the business can generate on a go-forward business basis and the risk of achieving those cash flows. But I think it's important to note that it is a guide, and that often when we do valuations, which we'll get into a little later on, adjustments need to be made to historical results in order for them to be a reflection of what a business owner or a buyer expects on a go-forward basis. Determined at a point in time is also very important. If we think back at some of the kind of major economic disruptions of the last, let's say 50 years, one of them would be 9/11. Like, if we did a valuation pre or post 9/11, the results of the valuation may be very different. So it's important to understand that just because value is determined today doesn't mean maybe a week from now that valuation might not be different. COVID, although has lasted arguably 3 years, a pre and post COVID valuation or a valuation at the beginning of COVID versus a valuation today could look very differently. And it's not just macroeconomic conditions that change. Obviously there's changes within a business, from one week to the next. You could have a significant customer, and if you lose the contract with that significant customer, it may change the value of the business. So I think when the valuation is performed and understanding that it is point in time specific is important to the assessment of the valuation. And then the final bullet, refers back to the kind of business specific factors, such as, the customer dependence, the level of, assets in the business, and the risk and opportunities generally available to that business. So we think it's very important to understand that value doesn't always equal price. It's based on the fair value definition, and it's a starting point, if you will, if you were actually, going to market with your business, similar to the house example that I previously used. There are many, many factors that affect price that don't have to necessarily aren't necessarily related to the valuation fundamentals of your business. Oftentimes, we talk about a house, and let's say that you are holding offers and, there's a snowstorm that day and only one person comes to the table. That's very different than another day where 10 people might come to the table. And the negotiating power of the various individuals is different. If we go back to the definition, we're not always dealing with an open and unrestricted market. We're not always dealing with a large pool of buyers. We're not always dealing with people who have access to the same information. Some people are compulsed to act based on other factors that are going on in their life or in the business or in other non-related businesses. So there are many factors that affect the actual price that someone is willing to pay. But the notional valuation is a solid starting point, and one that allows for the comparison of one business to another, given that we're all using a common definition of value. So sometimes also when we talk about business value, it's a bit abstract. So I think this diagram helps to understand the components of business value. So if we start from monetary value, those are, let's say, cash, receivables, those types of things, they have the lowest risk. Cash is worth the same to everyone. Receivables carries a higher level of risk, but you can factor, we call it, sell their receivables, and someone would be willing to, buy those receivables and convert them to cash, basically wait for the people to pay. If we move up the risk spectrum, the next kind of level of assets in a business are tangible assets. So this could be machinery and equipment. So they're not as liquid as cash, and they are not everyone is interested in the same piece of equipment, unlike cash. So the risk associated with a tangible asset is higher. Then as we move up one more level, we have identifiable and tangible assets. So identifiable and tangible assets are things like brand, customer, technology. Those are the most popular ones, although there are others. And they are more risky because if we think about the risk spectrum, those are worth things to different people, and they're not as tangible as, let's say, a piece of machinery and equipment or cash. And the final kind of piece of that business value puzzle is what we call goodwill, which is a residual value, which is to say it's part of the value of the business, but you can't separate it from the business itself. So it kind of is part and parcel to the business. And that's the riskiest asset, given that it's unidentifiable in nature. So often we refer to a workforce as goodwill. We often refer to goodwill of location as goodwill. Things like reputation is goodwill. Like you can't really sell any of those one things without selling the business. But they're all still very important to business value, but they do carry the highest risk. So I think it's another way of framing business value in terms of the components of a business. And then finally, as kind of a business fundamental discussion, when we talk about business value, like we have to be clear on what we're talking about, with whether we're talking about enterprise value, which is at the left hand of this graph, or if we're talking about equity value. So if we go back to the house example, if someone were to ask you what the value of your house is, you might say, I'm obviously making up numbers, $3 million. But then let's say you had a mortgage of $1 million. So then if someone asked you how much equity you had in your house, you would say $2 million. So I think it's very important to understand in general, if we're talking about business value, we refer to it as business value, irrespective of how the business is financed, which is enterprise value, or if we're talking about equity value, which is, the equity that you have in the business. So like some of the reconciling items between enterprise value and equity value are any redundant assets, so assets that aren't required in the operation of the business, as well as debt in the business. So I think it's very important to understand the nuances of those two matters, because if someone's buying the shares in your business, which is the equity value, then they're typically taking on the debt of your business, and therefore, that could be worth a lot less than the value of your business as a whole. Often people ask us, what's involved in a business valuation and like, what are the steps? So obviously, we've simplified it for the purpose of this graphic, but, the first step is just gathering information on the business and holding interviews with the business owners to really understand kind of the nature and history of the business, like where the business has been, so to speak. So the background and history of like financial operations, and then where it's headed. So let's say the forecast or what's to come for that business. Then we select and apply a valuation methodology, which we'll go through later on in the presentation. And our final deliverable is a report. So we typically issue the report in draft in order to make sure we've captured the information that the business owner has provided accurately. And so then we discuss and answer any questions with the business owner. And finally, we issue our final report. So next, we wanted to talk about value drivers. So what drives value in a business? And these are the buckets that we typically think of when we talk about value drivers. And each slide will go into a little more detail on the components of value drivers. And obviously all of them are not present in every business. And, they're not necessarily good or bad. Some of them are viewed from the lens of investor and what the investor is actually looking for. We have investors on a spectrum. We have investors that, are interested in more mature steady state businesses. And then we have investors who are interested in, taking the risk and are looking for that big payoff. So it's not to say that any one of these items is good or bad. It's just an element that people look at when they assess business value and whether, they want to make an investment in your business or not. So the value drivers that we're going to start with are functional or technological value drivers. So some examples of what we talk about when we're talking about functional or technological value drivers are like uniqueness and differentiation of your product or service, ease and breadth of use, life cycle status, complexity or ease of replication. An example of, let's say, complexity or ease of replication, like Twitter has been in the news a lot lately, and Elon has become a more polarizing figure probably over time. And so people are talking about, is there an alternative to Twitter? And I think that there are, some new social networks on the horizon that currently exist. And they're talking about, if someone would come in and, create a new platform, social platform, to be a competitor to Twitter. So Mastodon is like one example of something that exists out there that people could move over to. So are there other, networks out there that someone could move over to? Another factor on this sheet is scalability. And so if we go back to the Mastodon example, I think currently Mastodon has 1 million active monthly users, and Twitter has, let's say, over 200 daily, I think, active users. So, there's one thing to have ease of replication and another substitute alternative, but, is it possible to scale it as well? Because in order for it to be a true competitor, it would have to be, scalable. So it's all things that, people look at when they're assessing, one business versus another business and kind of how to increase business value. Then we have commercial and financial value drivers. So if we compare two businesses, is there one business that can generate incremental profit margin over a different company? One is, market or potential for growth. Is the market, small, or can we kind of leverage the market maybe in other areas as well? Switching costs often come up. We do a lot of software valuations, and depending on the type of software, it's really embedded in the company's operations. It could be inventory management, it could be communication with customers. And so when it's harder to switch, the customers become more sticky, which increases business value. I mean, the flip side of that is then it's often hard to actually attract customers because you have to convince them that your product is worth switching for. Quality of management comes up frequently, especially in early stage investments. Often people are not even investing in the kind of business fundamentals or valuation fundamentals because the businesses are so early stage. They're really investing in the people. So I think that quality of management is important at all stages of a business life cycle, but I think, especially at the beginning when the business model is unproven, people really look to the quality of management to see if these are the types of people that they think, can carry the business forward. And that can change also, over the life cycle of the business. We see oftentimes, the people who are in a business or leading a business at the early stages are not the same as the people who are leading the business in the later stages. And I think that assessment is done for, every business. I think that an investor would invest in. Marketing is another big one. So if we think of, customer recognition, there's some brands that become ubiquitous in general. So things like Kleenex and Xerox, they're so identifiable that we refer to the product or the service kind of by the name of the, largest provider of that product or service. Certainly, marketing oftentimes is a differentiation. If we look at the largest and the most valuable brands, I think this year, include Apple, Google, Coca-Cola. There are people who spend a significant amount of money on advertising, which could be a differentiating factor. Potential for expansion and exploitation is often another one we think about when we talk about the value of a business or a brand. If we take, let's say, Peloton, for example, when Peloton first started, it started as a product, the bike, and then it became a subscription kind of software provider specifically related to the bike. And then they were able to expand their service offering to include subscription services for other fitness categories. So, there was a potential for expansion there. And then there are items such as legal, which we won't spend too much time on. I mean, it's not a evaluator's main area of expertise, but some things that one could think about is like ownership rights, protection status. Is it patentable, and like whether or not to patent is like a legal decision based on the facts and circumstances. That's not always the right decision, and there's pros and cons to applying for a patent. But it's just some things that people will, consider and assess when making a business investment. And finally, and as we've seen over the last couple of years, certainly there's external value drivers, things like, government policy, and just like macroeconomic trends. So if we think of COVID over the last 3 years, there was government policies, for example, that kind of propped up businesses during those challenging times. And, if we take COVID as an example, there were businesses that did extremely well at the beginning of the pandemic. So, just top of mind, like Peloton, as I referenced earlier, is a good example. Zoom is another good example that we're doing very, very well at the beginning of the pandemic because people were staying at home and people needed an outlet, let's say, for fitness, because a lot of the gyms were closed. In the case of Zoom, they needed a communication tool to talk to one another. And, at the beginning of the pandemic, people weren't sure, or these companies, I think, believed that, the landscape of the world had changed, that we weren't going back to kind of the pre-COVID environment. But as we've seen with some of these companies, there has been a significant drop in their business value because the landscape has changed, both because of macroeconomic conditions, but because, people are no longer staying in their house as much, and have returned to either in-person or in-person learning in the case of schools, or in-person in the case of work. So I think a company like Peloton, I think their stock is down something like 70%. I think Zoom is very close to that. I think it's down 60%. So, it also circles back to the conversation we were having at the beginning of the presentation, which is, it really is point in time specific, and no one really knows what the future holds, and everyone is kind of making bets on the future. And so depending on how those bets play out, certainly impacts business value. So, the macroeconomic conditions that exist when we doing a business valuation, in addition to the business fundamentals themselves, really do affect a business. So a question that often comes up is, how do we approach business value, and how does a business valuation get affected? So in terms of approaches to valuation, there's 3 main approaches. So there's an asset approach, an income approach, and a market approach. And we'll go through each one. So in terms of an asset approach typically involves the restatement to fair market value of the items on a balance sheet. So I would say an asset approach is often used as a secondary approach to understand kind of the tangible assets available in a business, but is not typically used as a primary approach, except for circumstances where the business isn't doing well, or sometimes if the assets of a business are not able to generate returns kind of in excess of, so the cash flows that the assets are able to generate are kind of result in a lower business value than the assets themselves, we conclude on an asset approach. Because if we go back to the fair market value definition, kind of fair market value is based on the highest price attainable. And if you think about it, if you sold your business and you could get more for the assets of the business than kind of the business was worth as a whole, you would likely just sell the assets of the business, which is why that definition is structured that way. The other time when an asset approach is sometimes useful is at the very beginning of a business's life cycle, when it's very startup in nature and the cash flows aren't there yet. It could be that an asset approach is the right approach in those circumstances. More often than not, we're looking at an income approach. And under the income approach, there's kind of two main approaches that one could use depending on the fact pattern of the business. So in the case of a mature or steady state business, the value of the business is kind of based on the maintainable, normalized earnings of that business. So earlier in the presentation, when we said valuation was prospective or future oriented, this and that the historical operations were kind of a guide we can use to assess the future expectations of the cash flow generation ability of the company. This is, in a capitalized cash flow, we look back at typically 5 years, and then we make what we consider normalization adjustments to see, what the maintainable level of cash flows going forward would be. So some of the items we sometimes normalize for or are present in a business are kind of non-arm's length transactions, not market transactions, non-recurring or non-continuous, and we'll go through them in a little more detail on the next slide. So, in terms of kind of non-market expenses, oftentimes we have, it goes both ways. Sometimes it's excessive or sometimes it's insufficient remuneration to the owner or the family members. So, oftentimes we see that owners pay themselves above fair market value. And so we make normalization adjustments to bring it back in line with what a fair market value, so a non-related person would pay that person to do that job. So when we do valuations, we're always looking at it from like an outsider's perspective. So, often I ask myself the question, if I bought the business tomorrow, what type of normalization adjustments, would be required. So when we think about business value, we really have to take an objective look at, what a kind of, we call the market participant, what a participant in the market would do if they bought this business. And sometimes it goes the other way. Sometimes it's insufficient remuneration. So there's not enough cash flow in the business for, a business owner to pay themselves, so they don't pay themselves. But someone looking to buy that business would have to pay, let's say, someone else to do that job. So you would have to make a normalization adjustment to reflect that in your valuation. So sometimes the businesses own real estate, and real estate has a different risk profile than a business in general. So we usually consider the real estate a redundant asset. So if we think back to that graph of the chain between the value of a business and the value of equity, we often add redundant assets. And real estate is often one of the items that we look at as redundant to the business. So if we look at the asset as redundant to the business, we're going to have to impute a rent. So if I bought the business tomorrow, but I wasn't buying the building, how much would I have to pay someone to rent a space so that I could operate that business? Sometimes there's non-arm's length transactions. Sometimes there's a sister company that's not being sold with the business, and that sister company is providing some type of service to the business that we're valuing. So we need to ensure that that service that is being provided is being recorded at a fair market value. Often non-arm's length transactions are not booked at fair market value. I mean, it depends, but it's something certainly that you have to consider, because obviously if it's below fair market value, then if I had to pay someone who wasn't related to do that service, it's certainly going to decrease the value. It's going to decrease the cash flows, which would decrease the value of the business. Oftentimes we see discretionary expenditures. So discretionary expenditures could be things like donations, travel. Those are probably the most popular. There's obviously personal expenses. Golf memberships is often another one. But certainly, we try to look at it from that market participant perspective, which is to say that if I bought the business tomorrow, would I have to incur those expenses in order to earn the revenue? And, in some instances, there might be an argument to say that, those expenses would have to be incurred. And other times it's very clearly kind of discretionary or personal in nature, such that you wouldn't really need to incur those expenses to earn the revenue. And finally, we have like non-recurring sales transactions or expenditures. Sometimes there are one-off transactions that aren't kind of maintainable. So, that the backdrop of our normalization assumptions is, what is the cash flow that I'll be able to generate on a go-forward basis, or the business will be able to generate on a go-forward basis. And so non-recurring sales transactions is one of them. Some of our clients we saw during COVID, for example, had excess capacity. So they decided to, for example, manufacture something that was COVID related, be it protective gear, let's say, as an example, that increased sales by a significant amount during the pandemic years. And certainly I think there has been a decrease in the need for some of those things. Certainly, for example, masks, everyone was required to wear a mask at some point in time during the pandemic. And at this stage, many people aren't wearing masks anymore. So you could have these non-recurring sales that have to be assessed as, are they one-time in nature? We were doing that during the pandemic, but we don't plan on doing that going forward. So obviously we would normalize that out in our assessment of what we're expecting going forward. So a capitalized cash flow is used when we had that mature steady state business. But what happens in situations where we don't have a mature steady state business? So we use a discounted cash flow. So all that really means is that for a certain period of time, typically discounted cash flows happen over a 5-year period. A business is expected to grow in kind of we refer to it as non-linear, but in some pattern that is not kind of maintainable going forward. So, often you see this for early stage businesses or fast growing businesses or businesses in decline as well. Something that suggests that in the near term, the business is going to look different than it will thereafter. And, often people ask me, well, like, what's the magic of the 5 years? Like, there's really no magic of the 5 years, except to say that, with each year that a business owner makes a projection, short of businesses that have long-term contracts, it becomes harder and harder to forecast out. So the finance community generally is in consensus that after 5 years, it's very difficult to kind of predict what happens in a business with any degree of certainty. So that's why we typically use a 5-year period. I think the challenge with a DCF is that it requires a reasonable forecast. And I think that's where a lot of people have challenges and stumble. So, we often say that, the reliance that you can place on evaluation or, the credibility of evaluation often depends on the credibility of the inputs and assumptions used in that forecast. So, that's as a business valuator where we have a lot of conversations with the business owners to say, okay, so how much rigor was placed or, how much due diligence was undertaken, in your establishment of these inputs and assumptions and support for those, the forecast overall. Because honestly, that's where we spend probably a significant, if not most of our time, is on that assessment of forecast. And then when we think about a valuation kind of at the bare bones of it, it's like the cash flow that the business can generate on a go-forward basis, as well as the risk of achieving those cash flows. So once we have the cash flows nailed down, we assess the risk of achieving those cash flows. And certainly in a DCF environment, it's kind of different than a capitalized cash flow environment where there is some fact pattern that is changing on a go-forward basis. So we have to assess the risk of that kind of fact pattern going forward. This is an example of a discounted cash flow. And it's really I wanted a visual representation to kind of reflect how many inputs go into a discounted cash flow. Like obviously we have revenue, cost of goods sold, operating expenses, income taxes is pretty simple, but then we have like the working capital required to support the business and capital expenditures, and then certainly the risk factor. So there is a lot of rigor that should go into a forecast if the valuation is based on a discounted cash flow. And finally, we have the market approach. So the market approach really compares the subject company to other companies in the industry. So the starting point of a market approach is kind of determining, what one considers comparable to your company. And, we often get the feedback, this company is not really comparable to my company. And we understand that, like, no two companies are identical in nature, but we're trying to find the closest comparables to the business to give us some parameters or some framework. Oftentimes, the market approach is used as a secondary approach. So we use the income approach as a primary approach, and then we kind of corroborate the findings using a market approach. And there are reasons when we go to compare the two that lead to differences in the income approach versus the market approach, but some of those can be quantified. So I think the three main ways that we look at a market is, one is if someone has made an investment in your business in a certain class of share, we can look at the implied value of the company based on that investment. Certainly, if we go back to the valuation fundamentals, valuation is point in time specific. So if there's been a long delay between that transaction and when you are looking for business value, that has to be taken into consideration because, as we mentioned, there's macro and business specific factors that could change the value in those intervening periods. We also look at kind of the shares of public companies. We call it like enterprise value. Often it's enterprise value to like something like EBITDA, so EV to EBITDA. And we try to compare those public company multiples, trading multiples, to our subject company. And we also do the same thing for transactions themselves. So we can look at specific transactions in the market and look at those transaction multiples relative to the business multiples. Like, certainly if we're talking about a private company, there are private company databases that exist, but they're more on a survey basis. So they have to be interpreted, I think, with a grain of salt. And also, if we're going to compare private companies to public companies, there's obviously often a size diversification and liquidity difference between those companies that have to be taken into consideration, in addition to things like risk, growth potential, and stage of development. And, finally, COVID-19 considerations, 3 years later, we didn't think we would still necessarily be honestly, I think at the beginning, we thought we'd be, down maybe for a month and, things would go back tomorrow to normal. But 3 years later, we're still talking about COVID and, how it will impact various businesses going forward. And, the businesses that have thrived during COVID, will that continue or will that not? And obviously, there's been changes in the macroeconomic environment, including inflation and interest rates, that will affect business valuations going forward. So sometimes, when we're unclear as to how the future will pan out, we can also use kind of scenario analysis. So we can, envision various scenarios for the business going forward and kind of assess the likelihood of each scenario taking place. I think that I read an article this morning, about Meta and how, the anticipated rapid growth that, Zuckerberg was expecting, obviously didn't pan out coming out of the pandemic. So, he referenced macroeconomic downturn, increased competition, loss of ad revenue, that was lower than he had expected early on. So sometimes the scenario analysis can help us forecast out different scenarios where maybe in a more stable environment that wouldn't be needed. In some cases, in certain businesses, it might be worthwhile to look at a few different scenarios versus just one. And that wraps my formal section of the presentation.
Thank you so much, Amanda. We will open the floor to questions. So, as I stated at the beginning, please use the question and answer box on the participant control panel to type in your question. And just a friendly reminder that if you did log on late, this session has been recorded, and we will follow up with everyone at the end of today with a link to the recording, as well as copy of the slide deck. So it looks like there are two questions. The first is, how long does it take to get a business valuation completed? Understanding that some situations will be more complex than others. And it looks like it's a two-part question. And approximately how much should a business be prepared to spend on that?
Yeah. So you're right. Like it really depends on the circumstances of the business. Like I would say that on average, it probably takes, 4 to 8 weeks to complete a valuation. And we say like from the time we get the actual information, sometimes we kick off a valuation and, we have an information request list that we provide the business owners, and sometimes we don't get that information right away. So really it's 4 to 6 weeks of kind of active time from when we get the valuation, 4 to 8 weeks. In terms of pricing, it's very hard to say. What that didn't touch on in the presentation is that there's different levels of business valuation reports that we can provide, similar to the assurance world. So anyone who has notice to reader financial statements or review financial statements or audited financial statements, the valuation world works very similarly in terms of levels of report. And so the cost and time also depends on the level of report that one is looking for.
Great. Second question is, should a business valuation be certified?
Yeah, I think it really depends on the purpose of the valuation. In certain circumstances, so let's say you're putting your business up for sale. So let's say my corporate finance counterparts, there's probably less rigor that needs to go into that process because you want an idea for yourself what the business is worth. But when you put the business up for sale, the market is really going to tell you, what they're willing to pay for that business. Different from, let's say you're a shareholder and you're buying out another shareholder, and the valuation is the only thing that you're going to rely on, or the primary thing that you're going to rely on in order to affect that transaction. Then I think you would probably want a certified business valuation because it plays a much more significant role in your decision-making process. But I think like in any event, I think you should always assess the person who's providing the valuation. Like I think that there are people without, designations or who don't do it on a full-time basis who try to dabble in valuations. And, they may be competent, but, often the valuation of a business is a very significant event in a business owner's kind of decision-making process and like in terms of life events also. And so I think that, doing due diligence on the person who's going to prepare your valuation is very important because I think you have to feel comfortable that they will bring the right skill set, background, and experience to the table when they undertake the valuation.
Of course. Do you have a valuation model in Excel using the discounted cash flow method, one of the common methods for valuation?
Yeah, like our valuations like are Excel based, so that's certainly what we use to do our valuations. But if the question is like in terms of a template, like it's something we use internally that's proprietary to M&P that we use to build our models.
And in what scenario is the income approach used over discounted cash flow method? You're saying growth stage startup.
Yeah, so a discounted cash flow so the income approach is an umbrella term that encompasses a discounted cash flow. So typically in an early stage growth, like an early stage company with high growth prospects, you're likely using a discounted cash flow to reflect that growth, significant growth in the short term.
So we'll just leave the question box open for another minute. Anything at the moment. But thank you again for joining us today. Appreciate you taking the time out of your busy schedules to be part of today's webinar. Definitely looking forward to upcoming events in partnership with M&P. And stay tuned for an email follow-up this afternoon with a link to the voting as well. It doesn't look like there's any more more questions coming through. Amanda, I don't know if you want to just move to the slide that maybe had your contact information, perhaps at the beginning for a moment. So yeah, if business valuation is something that you are looking at doing for your business or your situation, and you are looking to hire a professional, Amanda's contact information is up. I'm sure she'd be more than happy to start the conversation with you. And thanks everyone for joining us. Feel free to reach out anytime. I will put in the chat box our email address, so feel free to reach out to us if there's anything we can do to support you through business growth. So thanks everyone for joining us, and hope everyone has a terrific day. Take care.